Securing your child's financial future is a crucial goal for parents, but this task can be slightly tricky if you are a parent of a specially abled child or a child with special needs. What all do you have to plan in terms of financial planning? Also, what are you looking at in terms of insurance? It becomes really vital. So let's get on board Shilpa Bhaskar Kole, founder, Nerdy Bird Financial Wellness, and let's talk on this very emotional and a very crucial topic. So Shilpa, thank you so much. Good evening and welcome to the Money Show. A very crucial topic, you know, a lot of parents of a specially able child might not even be comfortable talking about it, okay? Be it to their partners or their relatives or even to a financial planner. This is something which actually needs to be planned really well when you talk about financial future of those kids. But more than that, a lot of it needs to go in terms of counseling and getting the mindset right, okay? So I'm not sure if you've really come across clients like these, but then I'm sure you've been asked a lot of questions on these lines. What, according to you, comes up as a fear that these parents usually have for their kids who are specially abled?
Hi, Kavita, and thank you for having me on your show to discuss this very important topic. Like you rightly pointed out, there are a lot of fears that families with special needs go through on a day-to-day basis. And I think the most important fear is about having their child to be able to manage their lives independently and without their support. And unfortunately, there are many families in India, and data goes to show the percentages of families where there are special needs. And you will notice that a lot of them, even into their adulthood and old age, the children need that special care, because not only is it physical disability, but in many cases, mental disabilities, and also lead to them not being able to have the capacity to carry out their life decisions and life functions independently, Kavita.
Exactly. So when we talk about financial planning, what all are the aspects that one needs to really take care of? Are we also talking about the difference that might be seen depending on the kind of special needs the child might have? Does the financial planning really depends a lot on that? How can one just begin?
Good question, Kavita. So, yes, it does depend on the needs. And what I've noticed is that from family to family, the nuances are very, very unique to that family. So, for example, if you just take two families where they have a child with cerebral palsy, for example, there is one case where the condition is such that the child has a mental, disability as well as physical disability. Whereas there are other cases of cerebral palsy where the child only has a physical disability and is able to carry out every other function as any other child and goes to a regular school. So even within this, you see a lot of nuances, if you look at this example. So going into their financial planning, it's first very important to understand that like any other family, they do incur all the regular expenses that we do as well. And apart from that, there are certain additional costs which are very direct and straightforward if you look at it. So, for example, they spend a lot of money on assistive devices to help their child carry out their day-to-day functions. For example, you have special shoes for a child with cerebral palsy, and there are wheelchairs that come for them as well. And certain kids with, say, who are on the autism disorder spectrum, you'll notice that they need communication devices, especially if they are nonverbal. And all of these assistive devices, Kavita, also come with a certain cost, because especially in cerebral palsy, for example, all of these devices and tools have to be changed every few years as the child grows older. And none of them, all of them cost in, nothing less than like a 5,000 or an 8,000 or 10,000 rupees to the minimum. So this is one big cost, Kavita, that they incur. Apart from that, another cost is around therapy. So I'm sure you're aware that occupational therapy is something that the children have access to when they have special needs, especially in the case of, again, your autism, cerebral palsy, as well as your Down syndrome. So OT is something that is another cost which can go anywhere between 800 rupees per session to 2,000 or 3,000 rupees per session. So we're looking at a weekly cost of around 10,000 rupees alone. So that goes up to almost 30 to 40,000 rupees per month for just your therapy alone, be it physical therapy, your speech therapy, and all of it under the umbrella of OT. Apart from that, Kavita, there are also certain hidden costs that we don't talk about so often, like making spaces accessible for them. So even within their house, having in place a ramp for the child to be able to walk from one a slightly lower location to a higher location, choosing spaces and residential areas where they are comfortable living, like a ground floor house or a place which has a good lift for them to access. And even in terms of the places that they have access to, in place of shopping places or places to eat, they are very, very confined in terms of the choices they have as a family with special needs, to places where the child has access to the location and can get there comfortably. So that is also a hidden cost that is less talked about, Kavita. And another very important hidden cost here is around public transport. So a lot of these children cannot travel by public transport, say a public bus or an auto rickshaw for that matter. So, arranging a car and or having a cab to take you to and fro also leads to an increase in cost. And there are certain big lump sum expenses they incur as well, such as corrective surgeries as they go along. For example, in the case of cerebral palsy, there are always these surgeries around that the child has to get done every few years, in terms of hip surgery or a spine surgery. And these are not small costs if you look at it. So I think the first step is to try and assess what are all the costs that you incur, and try and preempt what are these expenses that you foresee going forward as well, Kavita.
So, Shilpa, how much of this can be covered by having the right kind of insurance? Or do you think that we don't have enough insurance cover for whatever expenses you just highlighted?
So, good question. And in 2020, IRDA had come out with a ruling, Kavita, that any of these congenital disorders, around autism, cerebral palsy, should be covered under insurance. Unfortunately, the covers are not very adequate. They're very small in amount. So, for example, if you look at autism, Star Care has an offer in place, as well as if you look at Religare, they have an offer as well for health insurance, ranging anywhere between 3 lakhs to 5 lakhs in terms of cover. And they do have certain sublimits as well if you go into the details of the policy. So that is one. And the government also offers something called the Niramaya health cover for children with disability that has a 1 lakh cover per year. So if you can pay an annual premium of 500 rupees if you're above BPL, you can also avail that policy. But is it enough to cover their needs? I don't think so. So often these parents have to look at creating a health fund, especially for the child, to be able to cover all of these corrective surgeries and medical expenditures, Kavita.
Shilpa, this is also the kind of care which parents have to ensure or maybe plan even after they are gone, okay? So here, there are two aspects which I want you to explain our viewers. First, the parents, their own investments and having the right kind of nominee, okay? Because then their investment, their money would go to the nominee, which in case could be their child or anyone else who would also be around with their kid as a guardian. Secondly, how do you also nominate the right kind of guardian?
Right. Good question, Kavita. So, in terms of guardianship, it's important for us to note that a guardian is someone who's going to take care of the personal affairs of the child and also the financial affairs of the child in case that is required and there is no trust put in place. In case there is a trust, then this job of managing the financial affairs can be with a professional trustee or a family member who can be made a trustee, or a friend who's a trustee. But otherwise, the guardian has a lot of jobs in terms of taking care of the child, ensuring their needs are taken care of, as well as protecting the child in the absence of the parents. So in terms of guardianship, number one, it's very important to make sure that this is someone you can trust, and this is someone who doesn't hold a conflict of interest when it comes to looking after the child and keeping the child's interests above everything else. So when looking for a guardian, I think these points are very, very important that the parents look at. From a guardianship perspective, Kavita, it's also important to remember that after the age of 18, any child, be it a special child or any other child, if you want to continue legal guardianship for your child, even as a parent, then you have to apply for legal guardianship. And this can be done by applying through the nationaltrust.gov.in, where you can go to their website, fill up the online application form, and then that will go to your local committee. And at the district level, it will be the application will come through. So that is in itself a process. So not just about identifying a guardian in case you are not around, but even your own guardianship is something that you need to think about after the child turns 18, especially if the child may not have the mental faculties to manage on their own after the age of 18, Kavita.
Right. But now talking about the future planning of specially abled child after them, what do you think in terms of legalities one should be keeping in mind? Also, we should not miss the aspect of having the right kind of will, which I think a lot of time people miss, even in a normal scenario. How can one go about it?
Absolutely, Kavita. I think the first step from a financial planning perspective is making sure that you have a will in place in which you very clearly list out all of your assets and what are those assets that you would want your child with special needs to have access to through a guardian or through a trustee going forward. The second important thing to mention in the will is about who this guardian will be. So making sure that you have a guardian in place and who the other one or two substitute guardians could be in case this guardian is not around as well. So making sure that the guardianship is laid out very clearly in the will is also important. And along with that, writing a letter of intent explaining to the guardian what are the needs of your child. So that is also something that is less thought of and should be taken care of in terms of future planning for your child in case of your absence. Another very important point, Kavita, is around having a trust. Now, this is again something that parents don't want to go down that route because they do foresee certain complications and having to go through all the legal hassles. However, I believe that having a trust is a very good way to set aside this money for your special needs child and ensure that there is ongoing financial care for the child in a very systematic manner, and making sure that these assets are ring fenced from any other, be it creditors or other people who would want access to your money in your absence. So having a trust in place with a very clear trust deed that lists out what are the objectives of the trust, what are the functions of the trustees, how this money has to be managed, how the distribution of the funds has to happen over time. These are certain things that have to be very clearly laid out so that in your absence, there's no fuzziness around it and there's no conflict around it for anyone. And making sure that if you can, clearly demarcate the roles of a guardian and a trustee, that would be very, very good for you because that reduces the conflict of interest of these two roles as well, Kavita. So this is something that I believe is very important to think about. And another piece that we've missed earlier is around term life insurance, Kavita. Often the funds that you have with you may not be enough to take care of your child in your absence, especially if the child has to go into adulthood and old age without being able to earn his or her own income. So in such a case, it's very, very important that you take a term life insurance cover and ensure that the proceeds of the insurance cover in your absence goes into the trust and can also be used to take care of your child's needs.
All right, one last question to you, Shilpa, and then we'll wrap up this discussion. I want you to give us some model strategies. I know it cannot be like, it's obviously case specific and not one size fits all. But then in terms of investment strategies, what can be thought about and what can be initiated?
Right. So first of all, it's very important that the family sits down and chalks out the timeline for themselves. Because if the child cannot function without them, even in their adulthood and their old age, then it's very important that whatever funds you're setting aside is not only for the childhood phase of the child, but also for their adulthood and their old age. So the first thing is to make this timeline and figure out what are the expenses that you envisage. So start with whatever you can possibly list out. There are certain expenses that you're already incurring month on month. Start by listing those out. Think about what are some of them that you could incur in the child's adulthood and what would also continue into old age for the child. Now, this is something which is very difficult to imagine, but go ahead and do this exercise to at least start to set aside funds for these different phases of the child's life. The second is, I think, by simple financial planning rules, make sure that you categorize all of these goals and these expenses that you foresee into short-term goals, medium-term goals, and long-term goals. And within short-term, you may have certain goals which are recurring, for which your regular income needs to take care of those goals. And there'll be certain short-term goals for which you need to be saving up in low-risk, low-return instruments. From a long-term perspective, Kavita, very important for us to think about inflation-beating instruments like high-quality stocks or high-quality equity mutual funds, as a route to save up. Especially if you look at medical expenses, we're looking at nothing less than a 14% medical inflation. I'm sure you've heard of that in the recent coverage on medical inflation. So it's very, very important that all of your money for your medium and long-term investments are thought of from an inflation beating standpoint, Kavita. And I think there we know that what could be better than putting your money in equity, but with the long-term horizon in mind. So even for a family with special needs, I would say that from an inflation beating perspective, do look at equity apart from some of the debt instruments that you are looking at, and diversifying into other instruments like gold and real estate.
Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and let's talk about the real estate market. CII-Anarock report on the housing market highlights some very crucial trends of the residential housing market. Mid-segment houses, which is almost from 40 lakhs to 80 lakhs, dominate the new supply with almost 36% of the share, and this is followed by a premium category, which is 80 lakh to 1 crore, and affordable category, which is less than 40 lakh, holds up to 18% of the share. What does this mean for the entire market, and how is the festive season looking up? Let's decode all of this with Prashant Thakur, Regional Director and Head of Research, Anarock. Prashant, good evening and welcome to the show. So I would just request you to break down the survey. The highlights that I just stated were very few. What kind of price segments are we talking about where the share is in chunk, and also what areas, what kind of towns are we talking about here?
Hi, Kavita. So, in fact, before I break down the data for you, let me answer a question about how the demand has shaped up, and how we're looking at the upcoming festive season. See, to everybody's surprise, the recovery post-COVID has been pretty strong. In fact, in the year 2022, we sold close to 3.6 lakhs units across top 7 cities, which actually surpassed the previous peak of 2014 by 6%. And it was 40% higher than the pre-pandemic year of 2019. There are a couple of reasons. Affordability still remains to be quite good in spite of back-to-back interest rate hikes. The reason is that the price discipline that the developers have kept is kind of remarkable. They haven't passed on the entire input cost rise that they have seen to the buyers. And then, luckily, it has been a very strong momentum driven by end users. But what also we have seen that the lowest segment, which is affordable, which is 40 lakhs and above, has seen a decline. And what we have seen is that the premium housing, or let's say upper budget segment, has picked up, as you rightly pointed out from a survey. There are a couple of reasons why the affordable segment has taken a beating. Is number one, because of input cost increase. The cost escalation for this segment has been pretty steep, because most of the buyers of affordable segments, they come from unorganized sector, or they might be working in SMEs and MSCs, and they're yet reeling under the pressure of post-COVID effects. Their income has still not come back to pre-pandemic level. While this is not the case in the upper segment, where people are going out and buying, and post-pandemic they have realized that physical asset is quite important. A strong stock market performance has also helped this segment, upper segment, which has come out and bought the properties. A lot of upgrades have happened. Now, coming back to which part of the country is seeing strong demand. So I think MMR remains to be the strongest geography performing, followed by Bangalore and Pune. We are seeing strong demand and strong interest coming from tier 2 cities like Ahmedabad and Lucknow, Kochi, Jaipur. Because post-pandemic, what has happened is that most of the commercial offices, most of the companies are also looking at tier 2 and tier 3 as a possible destination for them, thus creating creating a kind of employment hub over there. So this is what it is happening. And this demand, this comeback, or let's say this recovery in real estate, this time is pretty different what we saw post global financial crisis. This, I would say, recovery is based on a solid fundamental. Post RERA, we have a very strong and disciplined market. This is end user driven market, not investor and speculator, and that's the reason I think we are expecting for a continued momentum in the sales demand. However, this upcoming festive seasons would be a testing ground if the momentum and demand continues, I think we can say that yes, we are in a long-term upward cycle.
Exactly, this festive season could be like the crucial period to understand the nature of this demand. But then having said that, Prashant, earlier post-pandemic, when we had just come out of the pandemic, a lot was talked about the pent-up demand. Now we are seeing inflation is a concern, and rising interest rate obviously is pinching, the pockets of people out there. But what's the nature of this demand? Are you looking at it as a need-based demand? Are you looking at it still being a pent-up demand? Obviously in the festive season, because last year we saw, there was a bumper demand across the categories, and in fact even luxury market was doing well. What is the nature of this demand that you're able to understand?
See, first we need to understand that India is primarily a housing deficit country. The reason we saw a prolonged slump, for a decade till the recovery we saw post COVID, was because of various different reasons. There was no regulator, lot of fraudulent players were there, completions were not happening, a lot of projects were being abandoned. Now, if you see in today's scenario, we have a very strong regulator in form of RERA. Most of the launches are being done by grade A developers. And I think RERA is pretty harsh on timelines. There's a huge penalty. And now the buyers are seeing actual completion and handover happening. So that has kind of led to a renewed confidence in the market. And then it's kind of, as I said earlier, that it's an end-user driven market, that it's a need-based driven market, not investment driven market right now. And if you look at the interest rate, though it has inched up quite steeply, it is still well below what we used to see. There were days when the interest rates were in the range of 14 to 16%. And having said that, the income levels have also gone up. And one interesting phenomena that we are seeing is that the average age of home buyers have come down. Millennials are stepping out and buying because they get a prolonged period for, repaying their home loans. So I would say that this recovery is based on solid fundamental, clean players are in the market, deliveries are happening, buyers have evolved, and it's more of a need-based market where developers are kind of listing. So, in a nutshell, I would say it's kind of right now a buyer-driven market right now.
All right. Can we also have the name of the cities that we are looking the demand going up actually, or anything unusual, even the trend over there that you've noticed?
No, see, to be, the data that we released through a CII survey was more focused around top 7 cities that we track, metros. So if I have to break it down, I think 40% of the sales in terms of value is coming from MMR region, followed by NCR, then Bangalore and Pune. Hyderabad is kind of in a market which has come back very strongly, but Chennai and Kolkata still remains, bit kind of slow as of now. They're yet to kind of catch up in terms of the kind of phenomena in growth that we have seen in other countries. And in tier 2 cities, I would say Ahmedabad has picked up quite significantly. Lucknow is a city where a lot of action we are seeing because it's more of a, lot of, I would say, government employees are coming out and buying, they're upgrading. I would say the acceptance of township living, gated community living experience is also kind of catching up in these cities. Then we have seen strong demand in Kochi, Jaipur, Bhubaneswar. And if you have to look at the reasons behind it, as I said earlier, that a lot of commercial activities are started to take shape in terms of a lot of IT and ITS companies moving near to their talent pools. So it's kind of a thumb rule. Wherever employment opportunity is generated, the residential development follows. And that's what we are seeing in tier 2 cities.
All right, let's see how the trend continues during the festive season. Thank you so much, Prashant, for being on the show and helping our viewers with this.
Thanks.
On that note, let's take a quick break, but then post that, we will talk about your financial portfolio queries, and we will also decode the trend of passive investment that's catching up with a special guest on the show. See you after the break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and the thing that's flashing on your screen is our WhatsApp number and email ID where you need to send us your financial portfolio queries. But then let's move on. Recently, a survey revealed that 61% existing mutual fund investors have invested in at least one passive fund. Of these passive funds, almost 87% of them have invested in passive funds through index funds, while 41% have exposures to ETFs. Now, report also says that passive funds have gained traction as its contribution to the total AUM has increased from merely 1.4% in 2015 to over 17% in 2023. So, is this the reason why fund houses are going the passive way, or is it just a herd mentality that investors are falling for? Let's discuss all of this. I have Kaustubh Belapurkar, Director, Fund Research, Morningstar Investment Advisor India, with me. Kaustubh, good evening and welcome to the show. So, what do you have to say about the trend? Is it just herd mentality, or investors are really following the Western pattern of investment, which is the passive way?
Sure. Hi, Kavita, and thanks for having me on this conversation. I think a very interesting point of discussion, right? Because when we think about the whole passive versus active debate that's obviously been boiling over in the Western countries, like you mentioned, for a decade or more, and clearly the data there is clearly showing that more and more money is moving towards passives in countries like the US. But when I think about the local context, right, there are various aspects to this. And more recently, obviously, we've seen a lot of action in terms of new passive fund launches, increased assets or money coming into passives. But I think from an Indian ecosystem perspective, and this is true even for globally, it's never an active versus a passive debate. I think both are crucial for the market, right, from a mutual fund industry, and from an investor's perspective too. And I think a few things are very important to highlight and note here. So few things are happening, right? So one is there are newer asset managers who are getting licenses or launching funds in the country. And I think it's a healthy mix of both active shops and passive shops, right? So we've seen certain new asset managers come up who are very investment focused, active alpha shops, and they've launched their strategies over the past couple of years. At the same time, we have certain shops that are either been launched or rebranded or coming up very soon, whose focus is purely on technology and reach, right? And they've gone the passive way, where they want to get the low cost sort of investing across the length and breadth of the country. So I think both business models can work, and obviously it's dependent on the core competence of the asset manager that was looking to launch that, right? The other thing that's happening is existing asset managers who have large asset active bases are also augmenting their product sort of bouquet with adding passive strategies on if they didn't already have it, right? For two reasons. One is obviously look at SEBI's mandate of one fund per category. So most of them already have funds within that. So on the passive side, obviously you can launch index funds and be ready for or have a product available for an investor who's looking for a passive investing option within the various options that could be available to them. So I think that's the reason which has added a lot of sort of new fund launches, assets to the passive side. A few other important things to note. I think before the taxation change for debt funds, target maturity funds on the fixed income side. So predominantly we had equity passives to start with, but on the fixed income side, we've had a whole host of target maturity funds, especially when interest rates were volatile, and there was a lot of investor interest in those funds as well. And I think the last thing which we often forget, so obviously the assets have gone up significantly, like you mentioned, in excess of 16-17% of the industry, but still a large chunk of that comes from the EPFO, sort of mandates that come in the index ETFs. But that said, I think retail investor, HNI investor interest is definitely increasing. But like I started saying, it can be a symbiotic world where both active and passive funds exist. It happens even in a evolved market like the US. So India is going to be no different in that sense.
Exactly. But not necessarily, Kaustubh, it also means that investors are not trusting the fund managers now and their alpha gaining strategies. This is not to be translated in that way, right?
Oh, yes, absolutely. So I think, I think the most important point, and like I was saying, that for an investor, it's not necessarily an active versus passive decision. Both of these strategies, even from an individual investor's portfolios, can definitely exist, right? And, talking about alpha, I know there's been a lot of conversations and a lot of discussions about, has alpha vanished for Indian fund managers? I don't think so, right? I think, on a long-term basis over a market cycle, the good strategies can still continue to generate alpha. But I must acknowledge that, it was a much more free-flowing alpha world maybe 5-6 years ago in terms of, every single manager could beat the benchmark. Obviously, the rules for benchmarking have changed now with the total return index. SEBI's categorization also has made the investment focus, much more focused for the asset managers. So all of that what has that resulted in? The quantum of alpha that a fund manager can generate has probably reduced a bit in certain categories. We talk about large caps. The percentage of assets or the percentage of strategies that can beat the benchmark will also, that's also come down, right? That's obvious that's going to happen. But there's a very important reason why we think that, for instance, like markets like the US, it's become very increasingly hard for active managers to beat the benchmark. So when you think about it, typically only 10 to 15 to 20% in certain categories of the active funds beat their, passive peers, right? But even if I look at SEBI's data, which they published in the consultation paper earlier this year on expense ratios, what we can see is that, and again, it's important to acknowledge it's not beating a benchmark, but it's actually beating a passive peer, because remember there are costs involved in investing in the passive peer also. And I think a healthy number, over 5 years, I think it's about 65% over a 10-year. In fact, it is almost 75-80% of the active funds, are beating their passive or underperforming the benchmark by less than 1.25%, which is really the hurdle. So I think active management is here to stay, right? And I use the example of the US, and why I think that we're still far away from the US example is from a very important data point. Is when you think about how much do Indian mutual funds own of the entire equity market as a whole, right? Of the Indian equity market, it's about 8 to 9%, give or take a few basis points, right? In the US, the same number is 30%, right? So when we grow larger as an industry and assets become 20% of the market or more, that's when a greater number of strategies can struggle. But I think right now there's enough and more space for active managers to perform. But investors need to keep a few things in mind, is that there will be style headwinds for each manager, active manager, which over the short term. So they have to ride that out and stay invested in the fund over a market cycle. And if they do that, and they've identified a good manager, just stay invested, and you will have a good, reasonable probability of making alpha over the benchmark if you've chosen the right strategy and stayed invested.
So one more question, and then we will take our viewer query. So the other question, and the last question to you is, what is the reason behind new AMCs mostly launching passive funds? Is it just the interest that they want to take advantage of, or there's a specific strategy that these new AMCs or even boutique AMCs are opting?
Yeah, so again, I think passives are also a very compelling investing choice, right? And I mean, they're low cost, they track an index, right? So there's, definitely merit in certain types of investors or investors within their portfolio construct having passives available to them. For instance, if I'm a new investor, I'm not sure of which fund to pick within a category. I want to say, for instance, I wanted to buy a large cap fund, but I'm confused because there are 35, 40 funds. And then what happens sometimes, it's called choice paralysis, that when you're presented with so many options, you just don't choose anything, or you make wrong choices and keep switching, right? To prevent that, then for a new investor or someone who doesn't have the time to make that choice or isn't working with an advisor or a distributor, then can perhaps, just to get exposure to the market, buy a passive fund, right? And that's what I think is the beauty of passives, where it's a very simple investing choice. And the newer AMCs who are tech enabled, looking to expand their reach to just beyond, not just to the the metros or the bigger cities, but beyond that, using their technology and the existing investor base, it becomes a very compelling investment choice that you can set up this platform where investors can get access to the index funds or ETFs, at a very reasonable cost, without having to worry about which active fund to buy, right? So I think that's really the way that a lot of these new AMCs will be looking at adding to their product bouquet.
All right, I think it's time up for this discussion, although I have a few more questions for you, but then I also have a viewer online waiting to get the portfolio answered. I have Mr. Naqvi. Hi, good evening, sir, and thank you so much. I think we took your question yesterday and there were some missing details that you've added today and sent us the portfolio. I think Kaustubh has the question. These are the funds that you were talking about yesterday, Mr. Naqvi?
Yes, ma'am. Yes, ma'am.
All right, thank you so much for sending us your query. So,
Hi, ma'am. Yeah.
Kaustubh, that's the portfolio of Mr. Naqvi, and he will add rupees 1 lakh on quarter basis, and he has, okay, I think he has a lot of funds in his portfolio. You might just want to filter that out, Kaustubh. All right.
Yeah, yeah, and I think when I just look at the list of funds in the portfolio, and given the goal and the timeline that's mentioned, of about 5 years and 60 lakhs that Mr. Naqvi wants to collect, and just scanning through the list of funds, I think the first thing that stands out, and I would sincerely advise Mr. Naqvi to think about, is that there are a lot of thematic funds within this space. So I mean, there's a healthcare fund, there's a technology fund, there's an infrastructure fund. There's also an active momentum fund, which is more of a smart beta fund. Now, what happens with these strategies is that it can be a boom and bust, in terms of performance for these. And typically, we only, advise investors who can take a judicious call in terms of, assessing what the theme is, that, are healthcare companies, for instance, looking great and I want to take some exposure, or is technology now kind of bottoming out and it's probably a good time to come in? Because, it can be very, very fraught with timing risk, in the sense that, you may get in or get out at the wrong time. And without having that, ability to take a judicious call in a particular sector, for most investors, we advise to stay away from sectoral thematic funds. And even if you want to dabble, not more than 5-10% of your entire portfolio, right? So that's the first thing that I think, Mr. Naqvi needs to think about. So I would sincerely, think about that, maybe just exit these funds or gradedly exit these funds, but, time is short, so probably, do the course correction now, right? The other thing, because it's a 5-year portfolio, and obviously in terms of just looking at what the current corpus, that's about close to about 5.5-6 lakhs, and adding 1 lakh per quarter, I think we need to be a little realistic about the goal, because it's 5 years away. We have about 60 lakhs to get. So the first thing we need to think about is we'll actually need to de-risk the portfolio. So not just in terms of de-risking in terms of the sectors and themes, but also adding in more or less volatile sort of equity into the portfolio along with some fixed income, right? So there is one fixed income fund that I see, a banking and PSU, but we might want to add more shorter duration strategies into the portfolio. But even for the equity portion, we want to build more allocation through a large cap and flexi cap, because these strategies will be a little less volatile than as compared to mid and small caps, where typically we look for at least a 7 to 10 year investing horizon, which clearly in this case, may not be possible, right? So I think that's one other thing that is very crucial to think about when constructing this portfolio. So I would recommend doing a fresh relook at the entire portfolio, definitely exiting the sectoral and thematic funds, maybe keeping a small and mid cap exposure to only 20%, build the rest through large and flexi cap stocks, in terms of, the funds that we like, Mirror Large Cap, ICICI Blue Chip, Kotak Flexi Cap. You already have a PPFS Flexi Cap, you can add some exposure to that. And very importantly, in terms of just doing the math on the portfolio, I think 1 lakh per quarter will not be enough to meet their end goal, because we have to also think about how when we come closer to the goal, we'll have to start cutting equity exposure. So I would think that about 1.5 to 1.6 lakhs per quarter is something that we need to start with now, and step that up by about 20% each year. I know it's a little aggressive, but we'll have to do it, because 5 years is otherwise not enough to kind of meet your entire goal. Either you'll have to, face a shortfall on your goal if we don't upfront these investments, or you'll have to extend your investing time period. So I think these are a few of the moving parts, which I would urge Mr. Naqvi to keep in mind, and kind of restructure the portfolio accordingly, and also set the investment expectations.
All right, all the best, Mr. Naqvi, with that. That was an in-depth analysis of your portfolio. But then we move on. Kaustubh, I have Jishnu on the phone line with me. Hi, good evening. How are you doing today?
Hi, Kaustubh. I'm fine. How are you?
Hi, thank you so much for sending us your question. You have HDFC Multi-Cap, Quant Mid-Cap, Nippon India Mid-Cap, Kotak Small Cap, SBI Small Cap, and SBI Liquid Fund in your portfolio. And okay, you have sent your wife's portfolio as well. Okay, so your goals are joint goals, right?
Yes.
6 crores by 2043
Yeah. That's what you're planning.
from both of these portfolio, right?
Yes, combined.
In combination, yeah, combined. Okay, got it.
Yes.
All right, Kaustubh?
Yeah, so Kavita, I'll have to apologize because I don't seem to have the numbers in front of me for this one.
Sure. Okay.
But maybe if you can just read them
Do you-
off, I can
Sure,
share
I
some
will.
thoughts.
So Jishnu has shared his portfolio and his wife's portfolio. The details will be flashing on the screen also. I'll just request the director to keep flashing the question in front of you. Jishnu has HDFC multi-cap, Quant mid-cap, Nippon mid-cap, Kotak small-cap, SBI small-cap in his portfolio. And his wife's portfolio has Quant flexi-cap, Mirror Asset Tax Saver, SBI Magnum mid-cap, Nippon Mid Cap, Axis Small Cap and ICICI Small Cap. They are investing almost 46,000 per month, and so far they have built 8.5 lakh in mutual funds, and they need to build 6 crores in 20 years, and they are also ready to step up their investment by 15% yearly. And he wants to know whether the current selection of funds is right, in tune with the goal that he's lined up for himself. And he's also looking at building an emergency corpus. He has separate RD also going on of 20,000 per month, and he will not need this money for next 18 to 20 years. So the goal of 6 crores by 2043 from both of these portfolio. Yeah.
Yeah, so I'll really cover this. Sorry, I have to apologize, but I'm completely blindsided with this question because I haven't seen it before. So I don't think it'll be prudent for me to respond without having done some analysis on this.
Not a problem. So I will just okay. So can you just give us a rough figure of accumulating 6 crores by 2043? What would be a monthly investment amount? If you could just calculate that and help the viewer. And Jishnu, we will take your question once again, maybe with Kaustubh itself, but in a later show. So how much should be the amount for 6 crores in 2043 that one should be investing every month? So far, he has 46,000, and he's also doing an RD of 20,000. I don't know if he should be adding that amount in an SIP also to raise it to almost 66,000 per month. But not bad so far. He's built almost 8.5 lakh in mutual funds itself. So what is your calculation saying?
Yeah, if you allow me just 1
Sure.
minute, Kavita, sorry about that.
Sure. So, Mr. Jishnu, you had this portfolio checked by any financial planner, or this is just your research that you've done and added all these portfolio?
Yeah, actually, from my research, the only thing is like my portfolio will be like mostly concentrated on mid and small cap because my horizon is on
Exactly,
like 20
that's what I
years.
can
So
see.
Yeah,
That's what I can see. It's quite an aggressive portfolio.
Yeah, like 70% is mid and small. Most my portfolio. So I achieve it mostly. So should I be reducing the small cap exposure and adding a new large cap or something like that?
Sure. So so Kaustubh, can I come to you?
So I'm just looking at the numbers now. So about 43,000 per month is the current SIP, if I'm correct, and a 15%
46,
step. 46, right? And a 15% step up is what's required. So I think we'll have to be a little more aggressive. I think if I just run the math on this, and currently about 46,000, and if we were to step it up by 15% every year, assuming a very reasonable return estimate of about 10%, and it can be more, but always err on the side of the caution. It'll probably result in a net portfolio value of about 7 odd crores at the end of 20 years, in 2043. Sorry, I just missed out. What was I think the goal was 8 crores, right?
6 crores in 2043.
6 crores. Okay. So I think then we're
yeah.
quite comfortable. So with the current 46,000 per month and, the 15% step up, we will, be very close to the ballpark that's required. Only a couple of things that I would keep in mind, right? One is that we can start with an aggressive portfolio, which I think Jishnu was also referring to, that, given that you have a runway to, 20 years, we can definitely have a slightly more skewed portfolio towards small and mid caps, but I would still recommend nothing more than 40% even though it's a long-term investing horizon, build the bulk of the portfolio with large caps. The other thing that we have to also factor in the calculations is, when you're about, 5-6 years out away from your goal, so in, 2035, 2036 onwards, start reducing your equity exposure, because, you want to reduce that event risk or the volatility of the portfolio as you're closer to your goal. And perhaps, so instead of 15%, if you build in 20% step up in the initial years, that'll be great, because that'll allow you to then build that buffer and kind of de-risk your portfolio in the last 4 or 5 years.
Right. So I think, Jishnu, so far so good. You're at least good on the SIP amount, but then as far as the fund mix is concerned, we will again take your question on the show. But then with this, Kaustubh, it's a wrap. Thank you so much for being on the show and helping our viewers with everything related to their financial portfolio today. And I'm going to leave our viewers with our WhatsApp number and email ID, where we would request you to send us your portfolio-related queries, anything to do with mutual fund or your investment strategies that you would want to decode with us and our experts. You have the WhatsApp number and email ID. Thank you so much for watching. Goodbye.